All content on this channel is for informational and educational purposes only and should not be construed as professional financial advice. Should you need such advice, please consult a licensed financial or tax advisor. No guarantee is given regarding the accuracy of information on this channel. So today we are talking about a pizza company, Domino's Pizza.
Yeah, of course. Right in line with all the other tech companies we've been covering. We're covering Domino's Pizza.
Because
such an obvious choice.
This entire podcast has just been one long, elaborate ruse for me to just get to the point where I could say that ordering a pizza for lunch is research.
Yeah, of course.
Yeah.
There's no way to know the new recipe. Is it good? Is it not good? It's the classic scuttlebutt. You're going to have to eat like 20 pies. That's what I said.
Well, so I don't have the app, and I just downloaded the Domino's app like a week ago. And like I ordered pizzas. I ordered their like cheeseburger pizza and a taco pizza and a bunch of other things. And I was actually really impressed with the app. I was impressed by like how much visibility they give you into the kitchen. Like they tell you the exact moment where like Aaron is preparing your order, but then there's like, it flips to the exact moment where the pizza is in the oven. And then it goes to, it's on your way. It's on its way. And it shows you the exact GPS location of your driver.
Yeah.
And when the driver shows up at the door, you get like a push notification. So you know how to like show up like right before they arrive. And then the person who's delivering your pizza is actually in a Domino's uniform, which like really surprised me because, you know, I'm used to like DoorDash or, you know, Uber Eats people who are basically just, you know, like mercenaries, you know, who are like not
who throw the pizza at your door and give you the finger and leave. Yeah, you know, typical excellent service.
Here's your 20% tip for that. But yeah, I was like really impressed, and you know, they were really friendly, and then the whole thing was just like very seamless and very quick delivery. Everything happened in like less than 30 minutes, including from like the part where I downloaded it from the App Store, set up my account and payment information, decided what I needed to order, and then put in the order and then had it delivered to my front door. Like that was actually like really, really quick and very easy. And then like, you know, even like navigating their coupons, they gave me like a 20% off my order. And I was like, sure, I'll buy 20% more. Let's see what's going on.
I'm in.
Yeah. And, you know, in terms of like the follow-up from the app, I have an Apple Watch. And like yesterday, I received a push notification in my Apple Watch, which is kind of aggressive. For some sort of Domino's special where you mix and match two items for like $5.99 each or something like that. And I was like, normally I would like immediately turn these things off because I don't want like to be interrupted in my day with like random push notifications for Domino's discounts. Yeah, but for pizza on my watch, on my wrist, you know, and I'm like,
it's like in the middle of an important meeting, you turn off all notifications. It's like, did you know that you can get you can get poppers with your pizza tonight for dinner? You know what? I didn't think about that.
Yeah. I'm in the middle of a job interview and my watch goes ding. Did you know? So
like I don't remember what commercial that is. Yeah, where you like it goes, it makes the Taco Bell sound and you end up like running out of the room or whatever. It's like middle of an interview. Ding! I'm sorry, I gotta go. It's a buy one get one,
it's important. It's important. 20% off. Like I gotta do this. Yeah. Do you want some? Do you want a slice? I can order you a cheeseburger taco slice. And you know, in terms of the food, it was okay. Like it was not horrible pizza. It wasn't like on par with some like really good local chain that's like the best in the area, but it's like a mom and pop store, which is normally where we would go to. But I would say for like commercial grade pizza, like fast food pizza, it was like slightly above average, and it was like better than I expected. Um, I could kind of like see why people would order Domino's like regularly, especially if they're where the area that they live in didn't really have enough density of like mom and pop pizza shops to have a good enough pizza location. Or if you're like randomly in some place that you're not super familiar with, you don't want to take like an hour of research on Yelp to like figure out what the best pizza place is in this random spot in San Diego. And then you just want to like have pizza quickly because your kids are starving, you know? So you just like go in the Domino's app, like, Domino's like right there. There's like one like 8 miles away, and then boom, you get your pizza because you know what it is. It's good enough, and you don't want to do the research of going to a sit down place. So that was my scuttlebutt from the Domino's app. I was quite impressed by that, and I could kind of see why they've been so successful.
Yeah. I mean, it's a crazy stock. I mean, you sent it to me, and I've actually poked around there. I remember a couple of years ago they had some crazy chart. Maybe I can find it and send it to you. It's from like 2017, 18, 19, somewhere in there, where it was like Domino's CAGR compared to like every darling stock you've heard of, like Amazon, Google, Netflix, like whatever. And it was just like Domino's. They just crushed everybody. And I thought it was a joke. I thought it was fake. Like Domino's pizza is crap. In my head, like, Domino's is not the best pizza. It's not the best of the chain pizzas either. The quick pizza. But I looked at it and it was real. And at that point I was like, I should probably track this stock. So I have owned and not owned over the last maybe 5 or 6 years. Whenever I saw that chart, I don't remember when it was. And it's been pretty good, but not so much as of late. It's actually dipped pretty significantly. I think everybody knows what Domino's is. I don't know, overseas, they don't have much of a presence, but I don't think our podcast does either. So I don't know if we need to like go into detail. They're basically quick service retail. So they sell pizza, they sell some other food now. They have a little bit more of a menu. They have, I think I saw 18,000 plus, almost 18,300 locations in almost every market in the US, and they are global. They have mostly US, I think. And it's almost entirely franchised.
Yeah, half in the US, half international. Yeah. So it's 50-50.
Right. Yeah. And I mean, I'm just saying their market share is primarily US driven. Right. They're like top of the chain in the US. I think they own like 20 something % of the US market.
Yeah.
Four players make up the top 52% of the QSR market in the US. They own yeah, I don't remember. I saw it somewhere. They own DPZ owns 22% of the QSR market share for pizza in the US, which is pretty good, and maybe 19%, something like that globally. So yeah, I guess everybody should know who they are. But they're trading now at about $431 a share as we record this. $60 billion market cap. It's a pretty big company, but it's not a massive company.
Yeah.
And they do about $4.37 billion in revenue. They're down pretty significantly from the beginning of the year, which is why this is an interesting time to cover it. I feel like every time we've talked about a stock, it's been all-time high or near an all-time high. Right. So it's down from 562, 565, 67, something like that, 565-ish per share at some point early this year.
Wow.
Maybe a buying opportunity.
Yeah. I haven't been keeping track of this stock. So I'm actually, I've never owned it before. So you have more history with it. I hadn't actually like realized that it had reached 550 per share. I think that it's done really, really well. And the thing that like I was trying to figure out was like, why has it done so well? You're correct. Like there's lots of pizza options in the US, and there's many people who like actually would prefer a mom and pop pizza shop. So like, what is it about Domino's that makes it such a strong performer over like all these years? And one of the things I started looking at is that like they really turned things around starting in 2010. And it's because their ex-CEO who had like a long tenure from let's say the early 2000s to his retirement a couple years ago. His name is Patrick Doyle. He decided to turn Domino's into a technology company that happens to sell pizza. And his challenge to his team in 2011 was that I want to make it possible. Is it possible for a Domino's customer who has a smartphone to just be able to order a pizza from us while stopped at a stoplight? And that's usually 17 seconds. Like, can we make this happen? And the team rose up to the challenge. They created like an app, and then they reorganized the way that they cook in the stores. They reorganized the way that drivers deliver stuff, which is actually like basically reorganized everything around this concept of if somebody needs to order from us, they need to be able to complete their order in 17 seconds or less. And they were able to do it. Like I looked at the way the app is today, and I'm pretty sure I could order in like less than 15 seconds, assuming that I've like set up the app and I have my payment in and I've ordered once before. I know I could do it. It's not that hard to do it. So I think they've achieved their goal. And I think the brilliance of setting an organizational question like that is that it reorganizes the entire company into one single mission that is actually really important for success, which is that you want to remove as much friction as possible between the customer and his pizza or her pizza. Yeah, you don't want to have like unnecessary barriers or slowdowns or hiccups that will prevent somebody from having an impulse to want pizza and them getting the pizza from Domino's. Like, you want Domino's to be the slipperiest hill that a person could actually ever encounter in the pizza ordering process, because there's so many options, and you want the Domino's pizza option to be like the easiest one to slide on, because people are lazy. And when I'm like tired, it's been a long day after work, and like the kids are hungry, sometimes you just don't want to like spend 30 minutes trying to figure out which pizza place you can get delivery from, or like what kind of pizza you want. You just want something that's like quick or easy. You could get it done in like a minute, and then boom, it's reliable. Like, you get your pizza like delivered to you in like 20 minutes later, and you can track it. So, that insight and organizing the entire weight of the organization to support that one insight, I think is the genius of this whole thing. It's why Domino's has made so much money for shareholders over the last 10 years.
Yeah, I do think there is something to be said for this company in particular as they embrace technology. So again, my day job, I try to sell technology to companies. I've sold products to Yum Brands. I sold some cool supply chain stuff to Papa John's. I've worked with Pizza Hut underneath Yum Brands. I've done projects with companies. Nobody's more eager for stuff than Domino's. They want to see everything. They want to evaluate stuff. They're happy to do pilots and proofs of concept. I still haven't done a deal with them for a variety of reasons, but mostly because we don't have anything that makes sense for them. But I remember I pitched 7-Eleven, and you go around and around in circles about how to get stuff done and what they're looking to do. And, everybody wants to be more technology driven, but Domino's really leans into that. It's like, if I can cut out 10 seconds from your delivery time, or if I can reduce friction by one click, that becomes primary for them. And I think that does differentiate them a little bit. One other thing we should cover, they're a franchise. We haven't really covered franchises yet. We talk about good brands like Peloton or whoever else we've covered. Even when we talk about like Starbucks, like, those are not franchises. Those are, owned stores. 98% of these are franchises. The nice thing about a franchise, for people who don't know how that model works, basically, like, if me and Gil wanted to open a Domino's, we have to pay Domino's money. They let us use the Domino's name, and then we pay them a percentage of whatever we sell, I think forever. So for Domino's,
every week,
it's an amazing,
forever.
Forever. And they're not the only franchise. There's a ton of franchises. I think Papa John's is also a franchise. I know 7-Eleven are franchises. So like, it's just a smart way to grow your footprint as Domino's without actually expending any OpEx. Like, you don't have to spend money to grow and expand and build a new store and put down a lease or whatever. You have people doing it for you, which is interesting. And so, if you look at the growth, and that's why I was talking about the revenue, they've got what we say 18,000 locations or something like that. The
Mhm.
revenue is growing at a compound annual rate of about 10% per year for the last
Mhm.
decade, which is insane. And again, that rivals technology companies. You don't usually see that in like traditional retail or QSR or food and beverage. But what's even more impressive is on that 10% revenue growth rate, the earnings per share is up almost 24% compounded
Yeah.
annually, which is just like when you don't have to spend any money to make more money and you keep making more and more money, it's a pretty
Yeah.
good model. And then when you compare that, again, just the long-term outlook, like if you're looking back on a decade, and we did this with Constellation too, we just look at past performance and you're going to be impressed, right? So I compared to Yum, right? They own Pizza Hut, like I said, and I think I forgot what else they own. They own a couple of different QSR companies, but twice the size, give or take. It's like a $35 billion market cap. They're negative 6% CAGR over 10 years. Right?
Wow.
And
That's
then I was like,
terrible
okay,
performance.
yeah, it's not good. It's not good. And then let's pick a company I like, right? Let's take Starbucks. Starbucks is, much bigger. It's a $110 billion market cap, give or take,
Yeah.
108 billion market cap. They're 9.5%. So they've underperformed Domino's on a 10-year period, despite this recent drop, by the way, which is insane. If you had done this in January, they'd be crushing everybody.
Yeah.
And then I was like, you know what? How are they doing versus like a real steady? I looked at Berkshire. Berkshire is a $700 billion market cap. They've been probably one of the steadiest growth companies over long periods of time that I know. Their 10-year CAGR is only 6.6%. So
Wow.
it's kind of like, if it was over a 1-year period or during COVID or 3 years, you're talking about 10 for a decade. They've outperformed like some of the best companies in their space and some of the best companies not even in their space that I would trust over long periods. So to me, that's why this is an interesting stock to cover. And the fact that it's down pretty significantly since its all-time high not too long ago makes you wonder what's going on with this company. And unlike Constellation, that just continues to rise at a pretty steady clip, it's not like there's a massive payday over the horizon or a huge risk to the business underlying the company. What's going on, right? What's a drop? That's a pretty big drop. That's a significant drop for the stock. Again, they beat earnings. They beat earnings every single time. Why is it going down? And what's the fear in this company? So like you said, what makes them good? I think there's a lot of things. I love the model. They're embracing technology. It's a growth. They've been growing really well. The story is really good. They've got an incredible track record of success. They open up stores very aggressively. They have great market share. What's not to like? But I think there's some stuff built into that looking forward that maybe puts people ill at ease.
Well, okay, here's the thesis, right? What if the recent drop from the 550 mark to about where it is trading right now in the 400s, 430, was caused because of really two things. One, just the general story of COVID, in the sense that maybe some people think that Domino's results were artificially boosted or inflated by the fact that people were staying at home and just ordering pizzas, which might be true, right? And now they're going to have a slowdown in same-store sales because people might not be ordering as much pizza. They just actually want to go and sit down and have like a quote unquote a real slice as opposed to a fast food slice. So that's one idea. The second idea is that, Domino's is trades like a growth stock, and its multiple, its market cap multiple on revenue is fairly high, even today after the haircut. And it's not one of those things that people traditionally think of as a growth stock until you start looking into it. People don't think of it as a technology stock until they start looking into it, right? Like the traditional tech stocks would be like Google, Facebook, now Meta, things like that. And like Domino's doesn't usually enter the pantheon of that thing, but it trades like a tech stock, and has a multiple of a tech stock. And so, when the Fed starts tightening up interest rates, and people are starting to discount the terminal end of their valuations for growth stocks, then that means you get multiple compression under the whatever metric you look at, like price per revenue or price per earnings, that kind of thing. And Domino's just got lumped in with the rest of those other growth stocks and, taken out behind the woods and beaten up, that kind of thing. So that's my idea about it. If I had to ask, is there something in the performance of the company that merits being taken out behind the woodshed and beaten? Like, there's really nothing. Like, it's doing really well.
I disagree with you. And I agree with you, and I disagree with you. I don't think it's only the interest rate and the DCF calculation that you kind of reduce the value of the company. I think there's other stuff going on in the world right now that would be bad for Domino's, I think, in general, right? One is cost of food, right? He said it in the quarterly report. He's like, food costs are rising dramatically. There's no good strategy. Like, if you're a low cost option for whatever food, they sell meat too. They have chicken tenders and other stuff, like,
and cheese
prices are through the roof.
Cheese prices are also high.
Yeah. Any animal product, that stuff's going through the roof right now. I saw a picture, I don't know, on Reddit today of, like, at Walmart, they started packing the meat in those, like, tagged containers. You can't steal them. Like the stuff they put Sudafed in,
Oh no.
Because it's so expensive.
Oh, no.
There's a huge shortage. So, like, I think the rising costs, I think he projected 8 to 10% of cost expected costs increase in the next year. That might be optimistic. And I think it hurts them more than it hurts. Like, if you're going to pay $100 for a meal at a nice place, you don't care if it's $120, right? But if you're going to pay $12 for a pizza and it turns out it's now $18, or you wanted to pay $9 for chicken tenders and now it's $14, it does make a difference, and it's very competitive down there. So I think food costs is one thing that, like, maybe the people are looking at the outlook for production and all the supply chain issues and all the farm issues. It's on the Daily also. The Daily podcast had an episode about farming and how the supply chain there is all messed up. Maybe people are looking at that and just being like, they're going to have to raise their prices to stay competitive. Their costs are going to go way, way up, and their margins will go down. And it's just not then that calculation changes. The other thing I also think is labor, right? Like, it's hard to retain employees right now, period. Everybody's bouncing around jobs. I see it in my job. I see it, all my clients, like, nobody wants to do work that, they don't have to do, or they don't want to do in some way. So maybe they wouldn't struggle with, like, another franchisee, someone opening a franchise. There's something maybe a little more there than, like, a delivery person or behind the counter person. It's tough to hire those people. It's tough to keep those people. I don't think in a job like that, like any restaurant, it's hard to motivate someone an extra $2 or $3 a year on your, or an hour or whatever on your salary. Like, nobody cares anymore. It's like, you know what? I'm just going to move back in with my parents in Omaha
and trade NFTs for a living. I'm going to trade crypto.
Yeah. And I'll buy crypto. Like, nobody wants to do that work. It's not an appealing job, and there's not a lot of growth potential in it. I think labor shortage plus increased food costs is going to hurt them. And I think maybe that's just baked right into the valuation. You see it, people are scared in macro markets, right? You watch commodities markets, soybeans, coffee beans, meat, cow, the ticker, like, just the price of things is going up. The commodities are going up. That's going to hurt a company like this at the bottom line. So yeah, you could see the valuation go down.
Yeah, I think that touches on something really important in the markets today, which is that there's going to be a bifurcation in the market. I think the market is going to emphasize looking into something very subtle and important for companies, which is that, like, what kind of pricing power does it have for customers? And the companies who have pricing power will do well and thrive. And the companies who do not have pricing power will not thrive. And the market.
What gives a company pricing power?
It's
right?
subtle. It's human nature that gives something pricing power. At the end of the day, this is something that you can't model on an Excel spreadsheet. You just got to handicap it using your gut sense. Basically, you ask yourself a question like, for this good or service that I buy on the regular, if the price goes up by 10%, will I continue to buy it, or will I stop buying it? And you answer that for yourself, and you answer that for what you think the mass of customers of that product or service will do as well. And the market's starting to make these determinations. And at the end of the day, I mean, the second question besides pricing power is also capital intensity. Because in inflationary periods, the price of materials increases. And if you have a business that requires a lot of capital, and let's say a factory, and then the factory depreciates, and then you have to replace it with a new factory in an inflationary period, by the time you are going to like get the goods necessary to replace your factory, it's going to be more expensive in the next time period in an inflationary environment than it was before. So you're ramping up, you're basically storing your profits during that time frame, but having those profits get eaten by inflation for the replacement cost of your equipment. So that's a separate thing. But right now, Domino's does not have that issue with capital intensity because it's got a franchise model. People basically contribute money as franchisees to the company so that it could open new stores and then give it like a weekly blood money as a percentage of like revenue. So it's very capital light. All they have to do is maintain brand, think up of new menu items, and then make sure that the app really works well technology wise. That's like nice. But the question that you're bringing up, which is that, as Domino's faces inflationary pressure, does it have the ability to pass its higher costs on to customers? And, it depends, I think, at the end, like on what your customer base is. See, like, for example, if Apple raises their prices 15%, I think the nature of the customer base of Apple would be like, this sucks, and I'm complaining about this on social media, but I'm still gonna buy iPhone 15.
Yeah.
Like, I'm gonna eat that cost,
Yeah.
So there, you're pretty sure Apple has pricing power. It could pass on higher prices anytime it wants. It's been doing it for the last 15 years, even without an inflationary environment. It's got no problems doing that, Does Domino's have that kind of like, upper tier customer base? Like, that's the real question. I don't know the answer to that right now. Like, because, on one hand, I think that the technology focus and the ability for Domino's to compete on service and reliability lends itself more to the type of consumer who has discretionary income and can actually absorb like a few more.
I would have said the opposite.
Because
I would have said that lends itself to the type of consumer that's price sensitive.
Okay, but here's my argument about it, right? Who are the people who value their time the most? Where they're like, who willing to like order stuff on a smartphone, and like they value things like the ability for Domino's to deliver at a precise GPS location on the beach or park that you're having a day out in, and just deliver to that location as opposed to a known address. Like, who values that? Like, I think people who have disposable income. So for those people, if my thesis is correct, if there are those people, an extra $3 on a $60 order, like, doesn't really make a dent in their decision-making purchase. They just want their pizza delivered quickly, efficiently, and reliably. And if it costs them $3 or $4, that's not a big deal. Like, they're price insensitive. That's my argument. On the other hand, like, if I'm thinking about like who would be price sensitive, like if you look at the way that their customers are split, they have like 50%. I saw this in a slide, like roughly 50% of their orders are delivery and roughly 50% of their orders are takeout. Like, people actually go into the store and pick up the pizza, okay? But interestingly enough, 2/3 of their profit are from the deliveries and only 1/3 of the profit are from takeout, which is weird. Like, how could takeout, which should cost you more to deliver labor-wise, give you more profit than the people who are actually showing up to your store and saving you the money of delivery? It's because the people,
they value their time.
Yeah, the people who show up to the store, they buy like a slice or something like that, or like chicken tenders, or like a little like a pretzel twist or whatever, a bread twist, and they don't spend that much money because they don't value their time. They walk to the store, But the
also, like, you're not getting a family meal. You're not bringing your whole family to Pizza Hut to sit down and have a $100 dinner, but you would order it to your house.
Yeah. Like, I could easily, like, if I were going to invite extended relatives over, and like have a pizza dinner, I could easily order 3 or 4 pizzas just to make sure everybody has enough. And then we have leftovers for like a couple of days.
Yeah,
That's
totally.
that's like a 60, 70, $80 order. And if they tack on an extra $5 for tip, I'm like, yeah, you know what? The delivery guy deserves the tip. He was carrying a lot of hot, heavy pizzas for me, and I appreciate the service, So
Yeah,
it depends. I think it depends on the customer base.
no, it's a good point. I think even if they lost, a percentage of that lower value customer, it doesn't hurt them as much because they've invested so much. I was trying to look at what technology they actually bought or where they've deployed, and it looks to be mostly around like, autonomous driving. You have some AI, you have some like delivery tech. They partner with a robotics company to do a delivery system in Houston, which is kind of cool. I was trying to read into that.
Mm-hmm.
I think everything you're saying is true in that if they can set themselves up as the most reliable, fastest, consistent delivery service, that's where their money is made on the deliveries. And if they can own that market, that's going to look much better for them in a downturn or in another pandemic or in anything that they've really invested very heavily in that area. And going back to the beginning of what we said, a lot of these companies use third-party delivery, and it is inherently less reliable. I think
Yep.
you get
and more
maybe
expensive.
you get really good. It's more expensive. It eats into. I mean, I think every QSR would love to have their own delivery infrastructure, their own
in an
fleet,
ideal
their own
world.
drivers.
Yep.
Because it costs them money to use the third party, and it's much better to have. I mean, in an ideal world, it's flexible. So the guy working the counter can get in the car and deliver pizzas, and it's kind of flowy with demand. Having a flex driving force would be ideal. So I don't know. I think if you're going to invest in any area, and then I think they did some work. I read they changed over their recipe. The pizza's better. Last time I had Domino's pizza, it was absolutely horrible, but it was a long time ago. So to be honest, like maybe that was old recipe. Maybe it was like,
was it before 2010? Because Patrick Doyle is,
oh man, maybe. Honestly, maybe. It's been a long time. I remember eating it and saying I will never eat that again. And then I believe later that evening confirming that I will never eat that again. I mean, I felt like I ate bricks. So I don't know. I can't really speak to the quality of the pizza, but let's just assume it's on par. I think you're right. If I'm sitting on my phone, it's like my kids are hungry. It's 6:15. I'm like, I got to eat dinner. Do I want to roll the dice with like, DoorDash delivering from a local pizza shop that may take an extra 20 minutes, and I can't really get minute-to-minute visibility on my awesome Apple Watch that I don't have? Damn you, Gil. Then maybe I would rather pay a couple extra bucks, and I think that's fair.
Sometimes I've looked at DoorDash just like at 6:30, which is peak hour, and I'll look at restaurants and it'll be like 45 minutes, or 1 hour delivery time. That's in my area, and at that point, it's unacceptable because I've got young kids and they need food like really quickly, and we've got to do the bedtime routine. And to wait an hour for delivery just doesn't like cut it. So at this point, and then not to mention like you have to like decide which restaurant you want to be eating at, and then also what you want to order from that restaurant. So that takes more time. If Domino's is just like ready with a known order that I know I've ordered before that I liked and that the kids wanted to eat, and I know it could get to me in like 20 minutes, I'll do it. And like for DoorDash, like sometimes like that hour wait time at peak is like not possible. Like I can't do it. Yeah. Like the kids' bedtime routines are gonna get in the way, So I think actually that's a big advantage for them to have vertically integrated the whole ordering and logistics system and built it out. One of the things that I saw as part of their marketing plan was this thing called the fortress strategy. I don't know if you encountered. I
saw that too. Yeah,
they call it the fortressing strategy, and they basically show geographic maps and like area codes and like a store dominating that particular area, and then for the next area, there's going to be another store that dominates that area. And basically the idea is like in medieval times, a castle would dominate the nearby region and protect it. And then you could harvest all of the income from the serfs, making agricultural products for the lord of the manor, right? And in this case, the
Yeah.
fortress is the store, and it is servicing this geographic area, and it's blanketing it with coverage. Anybody who wants Domino's gets quick service from that particular store in that particular region. So it's
Yeah. It's a good strategy. I've been reading. There's actually a local ice cream shop where I am. That's like they were written up in the newspaper about like being extremely aggressive, and their strategy is like a more combative form of fortressing, where like they find the closest competitor and open next door.
Oh
like
my god!
Every single one. Yeah, it's bananas.
Wow, that's like in your
so it's
face.
Interesting. Yeah, it's on my street. There's like an amazing ice cream place. It's like I think it's like the best I've had. And there's one of these shops next door. They opened next door.
So then what do they do?
Fortressing is.
Do they undercut the
Yeah,
other
they
store?
they come in. They put up the same similar. It's just very similar. And the thing with them, they're such a big chain here. Everybody knows them. So like if you're visiting, you go to what you know. They have a better brand,
right?
Which sucks because the local one is amazing. I think it's the best ice cream I've had. But yeah, it's like fortressing is more about defense, that you open around yourself. You open close to your own stores, and you're able to like block out an area where like, why wouldn't you order Domino's? Like everybody around you is order. So it's a little different, but it's definitely, I think it's a good strategy and has worked really well for them.
Yeah. And those stores, the Domino's stores, they're not really geared for like sit down eating, which is probably like the least profitable form of eating, because you've got to like have a waiter bring stuff out, get the money. People take a long time with the tables. It's like really hard to actually run a sit down restaurant. But like a Domino's store isn't actually geared for that. It's geared mostly to
not at all.
Either send you a pizza or you get your pizza and then you leave immediately, right? Like the carry out thing, which means that they don't have to spend as much money on rent because they don't have a huge footprint. And most of the CapEx is just building the oven and then making everything ready with the technology and then having labor costs, basically. The other point that you were saying, which was that labor costs are rising, is probably going to be true. That's going to like add to their inflationary pressures that they need to pass on pricing to their customers. But one thing that I did note that was really interesting was that they have some sort of statistic on their slides that says that like 90% of new franchisees actually came up from the Domino's system. Like they started off as a delivery dude or somebody
similar to Dutch
pizzas. Yeah. They're like, or Costco, like because Costco always promotes from within. And I think like that's probably like the hope, the ability to possibly move up is the best possible thing a company can offer and be able to be competitive on wages. Because you're right, like if for many people they're like, oh, $12 an hour versus $13 per hour, I'd rather just like stay home and not do anything or whatever. It's not worth it.
Collect my unemployment checks.
Yeah. But like for somebody who is got an eye in the future and actually wants, like has seen that it is possible to like come up from delivery driver to franchise owner of like 10 Domino's pizzas franchises, making like 6 figures, close to $1 million, that kind of thing. And you want to work hard for that, like this is the best possible path. Like they'll train you, they'll give you experience, they'll give you opportunities. All you have to do is work hard, save up some capital, and then open your first store. That's it. Like it's so simple, And I think
I don't know. There's some. It does. There's something about, and I'm trying to put myself in a younger person's mindset, right? Like, I don't know. You're coming home. Do you want to tell your parents you're working at Domino's Pizza and you hope to open a franchise? Or you could say, I'm working at this really cool up and coming coffee shop. It's called Dutch Bros. And, they only promote from within. I'm on a management track. Like, I don't know. Domino's is at a brand level. I don't think they have that cachet where they're going to be able to, get and retain talent, right? Yeah, maybe they can keep some people because they see career longevity there, but they're at a brand level. And you made a good point that like, maybe they're keeping their customers because of performance. And that could be true. They're just the most consistent, best performing delivery, whatever. But at a brand level, I don't think Domino's has any any upper hand on any of these other chains.
Yeah,
Pizza
it
Hut,
doesn't have a
Papa
huge
John's,
advantage.
Subway. Yeah,
I don't
no,
elevate
zero. I don't
like
think so.
Pizza Hut, Little Caesars, Domino's. They're all on the same level for me. I don't see one as being higher than the other. Like in a weird way,
you and I really needed. You know what we needed to do? You and I needed to go on a full blown like tasting tour. We need to try pies from all of those places, like multiple times. That's what we should have done for this podcast. Done like a full ranking. I haven't had them all.
Yeah, my doctor is gonna freak out on my blood test after the.
It needs to do it. I needed to do it for the pod. All 7 of our listeners needed to know which
the doctor's like
was the best pizza.
I'm looking at your blood test results, and you're gonna die tomorrow. that's what's gonna happen.
You're dead.
you're dead already.
It was worth it.
I don't know how you're alive. Yeah, so that's actually what we needed to do, because I actually haven't ordered a lot from these places. I only ordered Domino's, and technically, actually, like the thing that I like, if I'm thinking of pizza, I really think of like local mom and pop stores, right? Like I think of like a more authentic Italian place with like really good attention to the ingredients and then blah blah blah, right? And so like the biggest drag on Domino's is convincing people that they have a good enough pizza with a good enough service for it to be a reliable order, and versus what most people I think have in their mind, which is that when they want to order pizza, they want to order from like a mom and pop store with like a fresh pie, that kind of thing. And McDonald's actually has done that. Like, to be honest, like a lot of people order McDonald's because they think like it's tasty, which it is sometimes for what it is. But like fewer people I think today that they want to go to a mom and pop burger place. They'll just go to like a big chain, and it's like okay. And I don't know when that transition in the customer's mind that like that's like a good thing. Pizza hasn't yet, I think, made that transformation. Domino's, if it's playing the long-term game, wants to make that transformation, just like the way, the diamond cartels of South Africa somehow convinced us all that in order to get married, you have to pay the diamond tax. Meanwhile, like for centuries, nobody was using diamonds to get married,
And there's only so many of them because we're hoarding the rest of them in our vaults.
You need a diamond to get married, but we're not going to give it to you right now. So, I mean, like they convinced people over long periods of time where it was unacceptable to like get married with a diamond. And now I think Domino's long-term game is, our quick service pizza is what should be at the top of your mind when you order pizza, not like a small mom and pop like store. Like you don't want that pie. You want our quick pie, which is good enough. It's like the same way McDonald's did it too,
Yeah, totally.
So I think that's like the long-term case for them. And I don't know. What else? Do you want to get to the part where we talk about the buy? Or
you want to get to the important part of the podcast already? Jesus. Yeah,
I don't know what else.
I don't know. I had a little bit more on specifically the delivery tech, but I don't think it's worth going into because I think we both agree that if there is a differentiator from a technology standpoint, it's that, right? I don't think that they're using technology necessarily to make better pizza or to, employ people better, whatever. I haven't seen a ton of stuff, but let's assume that the technology is helping their delivery and that is a differentiator. I think I went first last time. You can go first. I have my conclusion on these guys.
Okay, so when I think about where they are right now, which is a 16 billion market cap, and I think we had established that the revenues were around 4 billion per year. They're trading at around 4 times revenues, which is pricey, but not like, let's say, a Tesla, which is 10 times revenues. That's like twice as much.
That's pricey,
right? Like that's a lot. And on the other hand, like Domino's has growth, but it's not like crazy growth. The total addressable market for pizza is going to be about 120 billion per year. So, and they can't take like that much more share Like they can't. I don't think they can take 100% share on that thing. Like there's gonna always be
Right.
other pizza restaurants. Um, so it's like they're steady growing into a like a slow growing market, and then they have some operating leverage in the sense that they're capital light. And then the biggest thing is that they don't have as much pricing power. I mean, we have to figure out what kind of pricing power they have at the end of the day, for an inflationary environment. But at least that they're like their capex is fairly low, so they're not like very intensive that way. Um, I think that there might be some more pain later on with respect to this. So for me, I would hold off and not buy Domino's yet, even though I do think it's a very, very good company. Um, my target for this would be if there is some sort of market disruption with Fed tightening and it gets down to something like less than 2x revenues, I would really think that that would be a really great buy point.
Yeah.
Very similar actually to like, when we both decided not to buy Peloton a long time ago at 40 billion market cap. Now it's like an 8 billion market cap. It's beginning to look like really tempting, like to start
It really
taking
is.
some bites in there. Domino's Pizza is not like at that like deep red buy zone level. I can be patient on it because I think if I buy it now, it's probably offering me something like 8 to 10% yield, which is good. But like maybe I could get a little better, like 12, 15% yield, that kind of thing, if I wait a little bit longer. Or if not, I just miss it. So that's just what I'm thinking right now. Like I don't feel forced like FOMO to buy this thing at right now.
I feel almost the same way. Again, makes for a boring pod, but that's exactly my look too. It's steady company. It's a good company. They've got incredible performance. It reminds me of Constellation in that sense, where they've picked an area and they're really, really good at it, and they have a track record of being really good at it. And I would fault nobody for buying, especially right now. It's down almost 20% or something over its all-time high. I mean, it looks better. It looks good. Like if you'd asked me in January, I'm out 100%. It's just way too expensive. But I think again, keep an eye on it type of stock. Same as Peloton, like we said. Same as Dutch too. Just keep an eye on it. If the price dips, I don't know if it's 2 times revenue or sales would be a nice bargain. I think if you can get it down there.
Steal.
Now
that would be a steal. I would be buying that.
That's a steal.
That would be great.
So you keep an eye on the stock price. I think the first barrier, and I don't do technical analysis, but I think if it gets below 400 a share, that might be the floor kind of dropping out, and you could see it go down to maybe like 350, 325, 300. And again, maybe it's in conjunction with food pricing, labor shortage, and the Fed tightening up, and all of a sudden the price goes. To me, at a long-term play, they are a little bit sticky. They may not have the brand, but I think their investments in technology, especially, will make them much more robust in tough times, right? Focused on really making sure the nuts and bolts of their online app, their delivery, the mechanics work really, really smoothly. And again, I think their customers value that. I think the people that order delivery pizza want those things to work every single time, 100% of the time. So it's a company I'd love to own. I think that's what I'm saying. It's a company I'd love to own. And I have owned it on and off for a while. But at this point, I'm not buying more shares. I haven't bought more shares in over a year. It just, as the price keeps going up, it's harder and harder for me to justify. But yeah, I'll keep an eye on it. This is one I would definitely add to my position. Again, and maybe it's in that like low 300s range. If there's a confluence of factors that can drive the price down that low.
Yeah, if there's a market panic, you could probably get it down to that. Yeah,
it's not
the
crazy.
Low 400s now.
It is.
Yeah,
it's in the low 400s now. I think people are skittish, and again, it's in the food industry, and that's an area that is very touch and go right now. People are nervous about long-term prospects about anything in food. So it's not unreasonable that it goes down another 40 points or 40, 50 points in the next 3 months. And in that case, I would definitely add to my position. Right now, it's still too expensive, so I keep an eye on it, and we'll see.
Yeah,
we have to revisit it.
one other data point I forgot to bring up was that they actually tell you what their projections are for growth, what they think is reasonable. The US
Yeah.
has about 6,400 stores right now, and they think the long-term potential is to get to 8,000 stores from 6,400. So maybe like, let's call that growing by a third in terms of their footprint in the US. But what's interesting is like outside of like developed markets like the US, the emerging markets, the opportunity that they see there is actually much greater. For example, I
Yeah,
was
absolutely.
surprised that in India they have 1,400 stores, which if you compare against the US 6,400 stores, it's actually like a fairly sized proportion for a place like India, where I didn't expect that people would love pizza so much, right? And they think
Yeah.
they could grow from 1,400 stores in India to greater than 3,000, you know? And so that's like nearly a double, whereas in the US, they just see growing by a third. And that, you stack on other markets like China, South Korea, places in Africa, and you can kind of like see a lot of incremental store growth there. I think what is important in the international community is the ability to have a blank slate and then reform people's impressions of what pizza is if they don't have like access to a lot of pizza, if that makes any sense, and then become like top of mind as like a premium pizza provider because it's like an American company and it's like a professional grade pizza or something like that. Like there's like some weird cultural differences where like in China, people think of KFC as a premium luxury brand, whereas in the US, we're like, I'd never eat at a KFC, that kind of thing,
Right.
But they
Yeah.
had the chance to like reset customer expectations going into a big market like China. And I think for Domino's, the incremental upside is taking that top of mind premium share in emerging markets. Like in India, the ideal thing would be in India, everybody sees Domino's as like the amazing luxury premium pizza place to go to, and everything else is trash. That would be
Yeah.
amazing.
That would be surprising. There is a Domino's near me, so I'm in Israel currently, and there's like a random local pizza shop and a Domino's, and it's kind of. I thought it was weird when I got here that it's like, of all the brands, I just wouldn't expect to see Domino's. I would have expected to see some local Israeli pizza company, and there is another one, but people order Domino's. They have tons of motorcycles and they're always on the road. And when I
Yeah.
go to a kid's birthday party, it's always Domino's. Like, I do think I don't know, again, I don't know if they're ever going to establish themselves as the premium pizza brand. But I do think they will, they have in a lot of cases and may continue to establish themselves as the most reliable pizza brand. And if that's the case, if I'm having my kid's birthday and I got to, the food didn't come, it's catered and I got to order pizza, it's going to be Domino's. So that might be interesting. Yeah, I don't know. Globally, I haven't lived in too many places internationally, but yeah, it looks like they are aggressive about expansion, and the franchise strategy lets them do that. Yeah, I mean they could continue to grow and continue to improve their margins with technology, and assuming they're not bit too hard by again labor and food and other stuff, and the Fed too. Yeah, I mean, it's a stock I would love and would love to own. It's just like they will perform if the market conditions allow it. They will perform, and they've
Yeah.
proven that over the last 20 years.
Yeah.
So yeah, this is a good company. It's a really,
Yeah.
really good company. They execute really well. I'm gonna have to order a pie tonight. I feel like it's the only way to end this
Yeah.
podcast.
Do some scuttlebutt. Ask them how busy they are.
Now I'm hungry. It's dinner time here, man. I'm starving.
That's good times. Yeah. So for me, it's going to be on the watch list. Like definitely one of the top names I'd be looking at in my watch list. If there's a market panic and things are selling at irrational prices, I'd probably want to buy like call options of this thing because 2 years from now it'll be doing much better than it was before, assuming that inflation is transitory, or maybe the other out is that they have pricing power that they can pass on to their customers. So
we'll find that out too.
Yeah, we will see. Got to keep track of this thing and then see how they perform. All right.
And all of our followers should post pictures of them eating Domino's and give us your rating. You get a consensus view on the quality of the pizza.
Only after we've bought in. Like we got to buy
Yeah.
in first, and then people got to start about doing this.
I mean, at least five to six orders are going to push the market, man. Like that's definitely going to make a move.
It's all sweet profit from there. Yeah.
Yeah. All right, buddy.
All right.
We'll sit this one on the sidelines. We'll keep an eye on it.
Yep. It sounds good. Catch you later.
Good show, my friend. Talk to you.